Right now, while you're watching this, the money sitting in your bank account is quietly losing value. Not from hackers, not from fees, from something far more invisible and far more certain. If you had $10,000 in a typical savings account in 2020, you'd need roughly $13,000 today just to have the same buying power. Your bank gave you maybe a few $100s in interest over those years. You lost thousands of dollars without spending a single penny. I'm going to show you exactly what's happening to your money, why your bank won't warn you about it, and what you can actually do about it starting today. Here's what makes this so dangerous. We've been conditioned to believe that banks are the safest place for our money. And look, I get it. It feels safe. FDIC insured, no volatility. You can access it anytime. But safe from what, exactly? Safe from theft? Sure. Safe from losing its value? Absolutely not. See, there are three major threats to your money right now: the inflation versus interest rate gap, the hidden cost of safety, and systemic risks most people never think about. And here's the part that really bothers me. Banks understand all three of these problems. Their business model just benefits when you don't. Let me show you something that should genuinely concern you. Most traditional savings accounts pay somewhere between 0.01% and 0.5% interest. Let's be generous and say you found one paying 0.5%. Meanwhile, real-world inflation has been running closer to 3% to 4% over time, in some countries even worse than that. That gap? That's your money evaporating. In 2020, if you spent $100 on groceries, that same cart of food costs around $130 today. Rent that was $1,500. Now it's closer to $1,900 or more in many cities. But your savings account, that $10,000 you had, the bank might give you about $50 this year. $50. This is what I call the silent thief. You look at your bank statement, see $10,000 and think everything's fine. But that $10,000 buys you less than it did last year. You're not standing still. You're moving backward, slowly, quietly, every single day. Now, you might be thinking, okay, but at least it's safe. At least I'm not losing money in the stock market. And that brings us to threat number 2, opportunity cost. It's what you give up when you choose one option over another. Let's say you keep $20,000 in a checking account just in case. At 0.01% interest, you earn about $2 per year. $2. Meanwhile, that same $20,000 in a high-yield savings account could earn several $100s per year. In short-term US Treasury securities, it could earn even more, backed by the government and designed to be held safely to maturity. Same money, similar safety, very different outcomes. And it gets worse. Banks charge maintenance fees, minimum balance fees, overdraft fees, ATM fees. Many people pay $200 or more per year just to use their own money. So now you're earning almost nothing and paying fees while the bank lends your money out at 8%, 12%, sometimes 20% interest. You're not really the customer. Your money is the inventory. So if banks aren't the solution, what is? Here's the good news. Fixing this is simpler than you think. You don't need to trade stocks all day or gamble on crypto. You just need what I call the 3-bucket strategy. Bucket 1, immediate money. Money you need right now or within the next month. For most people, that's 1 to 2 months of expenses. But here's the key. Don't use a traditional bank savings account. Use a high-yield savings account. These accounts often pay many times more than traditional banks, while offering the same FDIC insurance and easy access. Action Step 1. Move your immediate access money into a high-yield savings account this week. Bucket 2. Short-term money. Money you don't need immediately, but might need within 3 to 12 months. For this bucket, consider short-term treasury bills or inflation-protected savings bonds. They're backed by the US government and can be purchased directly. Action Step 2. Move excess emergency savings into short-term government-backed options. Bucket 3. Long-term money. Money you don't need for at least 3 to 5 years. Money that sits in a bank account for years is guaranteed to lose purchasing power. Money invested for growth has the potential to outpace inflation over time. Action Step 3. If long-term money is sitting idle, talk to a professional or explore diversified long-term investments that fit your situation. Here's the framework. Immediate money goes into high-yield savings. Short-term money goes into government-backed instruments. Long-term money goes into growth-oriented investments. Your money has different jobs. Stop using the same tool for all of them. Your bank isn't evil. They're just running a business that isn't designed to grow your wealth. But you have control. This week, check your rates. Move idle cash. Assign each dollar a job. And set a reminder to review everything twice a year. In today's world, your money is either working for you or quietly working against you. Don't let inertia decide your financial future. Now go move that money.